Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Teladoc stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Teladoc is a telemedicine and virtual healthcare company. Its primary services include telehealth, medical opinions, analytics, telehealth devices, and platform services. The company uses telephone and video conferencing software as well as mobile apps to provide on-demand remote medical care. It is the first and largest telemedicine company in the US. It acquired companies such as BetterHelp in 2015, Best Doctors in 2017, and Advanced Medical in 2018. In 2020, it acquired InTouch Technologies. This company is an enterprise telehealth solutions for hospitals and health systems. Also in 2020, it merged with Livongo, which will help this company improve the delivery, access, and experience of healthcare for consumers around the world. Livongo is pioneering a new category in healthcare called Applied Health Signals, which is transforming the management of chronic conditions. In 2021, it acquired UK-based telemedicine provider Consultant Connect. This company's specialty is facilitating healthcare professional-to-professional advice and guidance in the UK. TDOC is active in 130 countries and it has 54 million paying members. The company is headquartered in Purchase, New York and was founded in 2002. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, Sao Paulo, and London Stock Exchange. Let's get started with the model. This is a large cap company, 11 billion market cap. They're trading at $70 a share and they have 160 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow is negative, then positive, then negative, then positive. They did have their best year in 2021 at 130 million. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative every year. Revenue is a sales for the company, and that grows a ton from 400 million to over 2 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. The cost to maintain their platform is part of cost of revenue. Revenue minus cost of revenue gives you your gross profit, and that grew a lot from 300 million to 1.4 billion. Below that is their operating expenses. Their largest operating expense is marketing, and below that is their operating income, which is negative every year. They paid 80 million of interest on their debt, which is the most they paid in a 12-month period. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. An example of this is an asset impairment. Then you have your pre-tax income, then your taxes, and the bottom line of the income statement is your net income, which is negative every year. This is their income statement from their 10K. The top line is the revenue, the sales, and that was over 2 billion in 2021. A bulk of their revenue is from the monthly access fees. You could think of this as your monthly premium you pay for your medical insurance. 1.5 billion in the US, 240 million international, so it was 1.7 billion of their 2 billion of revenue. Sometimes you have to pay an additional fee if you meet with a doctor. That was 254 million. They earned the least revenue from other, 46 million. Some providers don't have the necessary technology to talk to patients. This company may lease out computers and different technology devices to those providers, and that's mostly in the other category. Their cost of revenue is 650 million. That gives them a gross margin of 68%, which is gross profit over revenue. The way you calculate gross profit, it's revenue minus cost of revenue. And their industry has about a 50% gross margin, so they're doing a lot better than their industry. They're always going to spend a lot in marketing. That's up to over 400 million in 2021, 250 million of sales. Technology will always be a big expense, over 300 million. 26 million of acquisitions and integrations, 438 million for G&A. An example of this is the payroll for support functions, and 200 million for depreciation and amortization. And that gives them an operating loss each year. They seem to be taking on more debt. They paid over 80 million of interest on their debt. which is about 2.5 times as large as 2019. The average number of shares outstanding in 2019 was 72 million. Now it's 157 million. It's more than double. In order to grow and scale your business, it's either through debt or equity or both. And that's the sole reason a company goes public, so it has access to the debt and equity markets. 2021 was better than 2020. They had a loss of $5.36 per share in 2020, but it's a lot better in 2021. Although 2019 was even less. But as long as their revenue is increasing, they should become profitable one day. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates or loses from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they generated a lot of cash flow in 2021, nearly $200 million. They spent $64 million of CapEx in 2021. This is mostly in their software. Operating cash flow minus CapEx gives you your free cash flow. And they did have a good amount of free cash flow in 2021, but they're just reinvesting that back into their business. They did add $1 billion of debt in 2020. They paid down $238 million. So they added about $760 million of debt. They added debt, $279 million, and equity, $331 million in 2018. They've been growing a lot through acquisition. You can see their investing cash flow was almost $600 million. When you acquire another business, the cash you pay goes into investing cash flow. This is a breakdown of their operating cash flows. And the way you calculate operating cash flow, you start with your net loss, then you have to add or subtract the non-cash items on the income statement, then adjust for changes in working capital. So even though they reported an accounting loss of $430 million, they actually generated nearly $200 million of cash flow. That's because they passed through $200 million of depreciation and amortization on their income statement. That brings down their net income, but it's a non-cash item, so we add it back here. And then $300 million of stock-based compensation, along with a bunch of other things. In 2019, they generated positive operating cash flow. In 2020, they had an accounting loss of $500 million, but only lost $50 million of cash flow. They passed through lots of stock-based compensation that year, $475 million. Stock-based compensation is a way of paying employees with equity using stock or options. A lot of young companies don't have extra cash. Instead of giving a big bonus, they may give stock. And it's a non-cash item for the company, so it decreases your net income on your income statement, but it doesn't affect cash flow. If a company gives options to their employees, those options don't affect anything until those options convert to stock. If the employee never exercises their options, then it doesn't affect the financial statements. But if the employee does exercise the options, it is dilutive. It will decrease the value of your shares. I like to track a company's revenue, that's the blue line, and their operating cash flow, that's the orange line. These two numbers are less affected by accounting tricks. Look at their revenue since 2015. It's growing at an unbelievable pace. And their operating cash flow is higher than ever at the end of 2021. The forecast is for their revenue to continue growing up to $4 billion by 2025. Same thing with their operating cash flow to continue growing. This is the investing and financing sections on their statement of cash flows. In the investing section, they spend $8.5 million of CapEx. They purchase $55 million of software. They do lots of acquisitions. They spent $79 million in 2021, $567 million last year, and $11 million in 2019. So in their investing section, they had a cash outflow of $73 million. Last year was a cash outflow of $600 million. In their financing section, last year they had a lot going on. They raised $1 billion by issuing notes. Notes are debt. They paid down $228 million of notes. They received $92 million from the Livongo notes. Last year in their financing section, they had a cash inflow of $860 million. This year was a cash inflow of $41 million. This is the equity section on their 12/31 balance sheet. They have $16 billion of equity. They raised $17 billion from selling their business, and they lost $1.4 billion from running their business. Let's look at the capital structure. $16 billion of equity, $1.3 billion of debt. They're 93% equity, 7% debt. This blue line is their equity balance since 2015. And it's really been growing a lot, and that's what you want to see when you invest in a company, their equity going up. and their debt is not going up that much, not nearly as much as their equity, and their cash balance is a little lower than their debt balance. I gave them the highest whack on Finbox, 6%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $14 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $12.4 billion. We divide that by 160 million shares. We get a calculated stock price of $78. They're trading at $70, so they're trading at a 9% discount. It's a buy according to the model. Their revenue is projected to be $4 billion by 2025. So to get $4 billion by 2025, I grew their 2021 revenue by 18.4% annually until then. That's how I got their future revenue estimates. The average company in their industry converts 12% of their revenue into free cash flow. So I multiplied their future revenue estimates by 12%. That's how I got their future free cash flows. So it looks like they're trading pretty close to intrinsic value. The website Simply Wall Street is a lot higher than me. They're at 166. They're saying the stock is 58% undervalued. 26 analysts priced this stock and the average is $99. The low is $67. The high is $161. This is where the stock has been trading since it IPO'd. It was a little slow coming out of the gate, but then it really blew up in 2020. It was almost $300 a share at one point. Like lots of stocks we've seen, it really crashed. It's down over 70% since the peak. It is trading higher than its IPO price. If you were a buyer of the stock when it was over $100, then you should really love the stock price now. If you bought the S&P the same time this stock IPO'd, you'd be up 92% with the S&P. With this stock, you'd be up 177%. But I'm sure you wouldn't be happy with that because at one point you were up over 1,000%. They have a low beta, 0.43, so the stock moves less than half the market. It's gone down 62% in the past 52 weeks, while the S&P is up 16%. The 52-week low is 50, the high is 195. And the stock is on a major decline, trading below its 50-day and 200-day moving average. 5 million shares are traded each day. Of the 160 million shares outstanding, 158 million are on float, 85% are held by institutions, and it has a high short percentage. Over 15% of the shares are shorted. Their employee count has been going up a lot each year, mainly through acquisition. They currently employ 4,700 people. If you invested $10,000 into this company when they IPO'd, you would have been at $100,000 at one point. But if you're still holding on, you'd be at $25,000 today. That's a 14% annual return. The only insider activity in the past 12 months was by Arnon Gashuri. He ran the HR department for Google for many years and then for Tesla. Now he works at this company. 85% of the company is held by institutions, 14% by the general public, and 1% by insiders. Cathy Wood's fund ARK Investment owns 11.8% of the company. The next biggest shareholder is Vanguard, then Bailey Gifford, BlackRock, and Nikko Asset Management. Let's look at their financial ratios. We can't look at the PE since they have negative net income. Their price to sales is decent at 5.6. That's stock price over sales per share. The market average is 9.3. The median is 3. Their price to book is below 1. That's stock price over book value per share. And the way you calculate book value per share, it's equity over shares outstanding. Equity is on the balance sheet. It's assets minus liabilities. They have $16 billion of equity, but they've acquired so many businesses, they have negative tangible equity. Let's look at their non-current assets. 27 million are PP&E, 15 billion of goodwill. Goodwill is the premium you pay when you acquire another company. 1.9 billion of other intangible assets. That 1.9 billion is made up of 1.3 billion of client relationships. When they acquire another company, they need to look at that company's customer base and then project the future value of those customers. That's an intangible asset. So the value of those future customers' revenue and profits is about $1.3 billion. And they're amortizing that over about 15 years. The value of the trademarks they received is $280 million. The original value was $326 million. $46 million was amortized. Software is $85 million. Technology is $278 million. They have $47 million of operating lease right-of-use assets. So they're leasing an asset that's owned by another company. So they put it on their balance sheet as an asset and as a liability. and $21 million of other. Let's look at their non-current liabilities. The operating lease we saw in their non-current asset section, the future payments on that lease is $42 million. They're not behind $42 million. It's the present value of the future lease payments. That's $42 million. $3.8 million of deferred revenue. So if a customer pays for their monthly subscription 12 months up front, this company puts it onto their balance sheet as a liability. Then each month the customer uses the service, they take that dollar amount off their balance sheet and book it as income onto their income statement. They received $9.3 million of advances from other companies, $76 million of deferred taxes. This should increase their tax bill in the future, and they owe $1.2 billion on convertible notes. If their stock price goes up a lot, then these notes will convert to equity, and they won't have to worry about this debt anymore. Although if that does happen, it will increase the shares outstanding, and it'll make your shares less valuable. They have a high current ratio of 3.7, that's current assets over current liabilities, and a high quick ratio of 3.5. Let's look at their current assets. $900 million of cash, $170 million of receivables. This is how much money is owed to them. $73 million of inventory. The inventory are computers and other devices they lease out to companies. $87 million of prepaid expenses. These are products or services they made an advance payment for that they're going to receive in the future. Let's look at their current liabilities. $47 million of payables. This is how much money they owe others. $103 million of accrued expenses. These are expenses the company has incurred but hasn't paid it yet. $92 million of accrued compensation. This is what's owed to their employees. $76 million of deferred revenue, and $13 million of advances from other companies. In 2021, they generated $130 million of free cash flow. They have $900 million of working capital, so they have over $1 billion of funding. So it looks like they do have enough money to get through the next 12 months without adding any more debt or equity. Although if they want to acquire another business, which is likely, they will need to add debt or equity. The best way to look at ratios to compare them to companies in the same industry. There are 58 companies in the same industry as TDOC. And if TDOC has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They have a really good debt to equity ratio. They're the third largest company on this list in terms of market cap. The average is $3 billion. They're over $11 billion. The top two companies have positive earnings since we can see their PE ratio. TDOC has negative earnings, so we can't look at their PE ratio. TDOC is a little better in price of sales than the average. They're a lot better than Viva Systems. And the reason people like this stock is their 3-year annual growth rate is 69%, which is much bigger than average. So to summarize, I have them trading at a 9% discount. And this company was around well before COVID, but COVID really expedited the growth of this company. It showed us more of a need to stay at home to talk to a doctor rather than going in. In a majority of situations, you don't even need to go to the doctor. There may be some instances where you do need to go to a doctor because they need to physically test you on things, but a majority of the time, you can do it over teleconference. That's why this company has really been blowing up. And I do see this industry continuing to grow. And I think the stock has come down enough where it does seem like a good value now. It may come down a little more. So if you're looking for a swing trade, it may be risky, but for a long-term hold, I think it should be okay. I rank their free cash flow as 5 out of 10, their revenue 8 out of 10, and their ratio is 4 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.